So, Bob, at one point you said that there are four different types of loans that community banks and credit unions won't make.
Yeah,
And
or let me qualify that they are reluctant to make these kinds of loans. Let's start with the four kinds of loans that at least we've identified that community banks are reluctant, or any bank is reluctant to make, and I'll give you the reasons why for each. The first are long-term loans, and with the exception of mortgages, where there's a secondary mortgage market that a bank can sell that mortgage off and and liquidate the amount of money it has tied up in a long-term mortgage. With that exception, banks do not like long-term loans because and this is a daily occurrence in a bank, if the withdrawals from the deposits by the people who have their deposits are a little above what the bank needs in terms of its liquidity to make more loans, then it can borrow from the Federal Reserve, or it can borrow from a correspondent bank, or in the case of a public bank, it can borrow from the public bank. But if it's borrowing at a rate that is greater than the long-term loan that it has out, it is underwater on that loan. In other words, it's losing money. And so they don't like to be in a position where they've got a fixed rate on a 10 or 20-year loan. And if the interest rates suddenly go way up and goes above what that long-term loan is producing, they're in trouble. So they don't like long-term loans unless they can unload them in the way they do with mortgages to a secondary market.